we were just mentioning how there was like a small percentage of leadership in the market in the past 10 years or so, but even this year, bull markets are strongest when they are broad and weakest when they are narrow to a few hands of blue chip names. That's like a rough rule number 7 of Bob Farrell's rules. So right now we don't have a lot of momentum in the stock market. We have no momentum, breadth. Breadth is whenever a lot of stocks participate in an uptrend. So Walter Deemer, he began this breadth indication way back a couple months ago, and we've been following it. And I've been following what he's been saying as updates every now and then. And he's been making comments that it looks as though that we're going to start going down, or it's not going to be going up like it has been this year in the stock market, because we don't have a whole lot of participation. The small caps haven't been performing. If you look at the S&P total weighted index, it isn't nearly up as much as the S&P regular. So we do have a situation. We have very small, select amount of companies, Microsoft, Apple, the big tech stocks that are carrying the market. And Walter Deemer basically says that's it's kind of a weak market right now. And if we look at our statistics, our stochastics, you can see, like you were saying, Matthew, about if we're going sideways, I traced the sideways pattern in the S&P. We're basically pretty close to that top of that range. So it looks like we're going to be going in the sideways pattern because the S&P earnings aren't increasing this year. And a lot of the stocks we're following were basically the top of the range of our channels. So it's a very good indication that we've, in a lot of what we're following, we're reaching like a top. And in most stochastics, we're halfway, like 60 out of 100. So we're not overbought, we're not oversold, but we're nearing the top of a range. So don't be surprised, if we start going back down and go in this range up and down for the rest of the year.
The reason why those tweets you had there, I really wonder what his definition of blue chip is. I feel like I knew what a blue chip was in the 80s. I don't know if I know what a blue chip is today. Like, well,
yeah.
Are the FANG stocks blue chips? Like,
I think so. Yeah. So
I guess I would. Yeah, I don't think that's the traditional name of blue chip. So
Bob Farrell, he wrote these like in 1957. So the terms he used terms in 1957, but you got to translate them into what it means today. So he has these rules, and they've stood the test of time. So markets tend to return to the mean over time. So when we're looking at the S&P 500, let's look at what Brad's S&P. Hold on, we're getting there. Okay, we're looking at the S&P 500. It's averaged like a PE of 15 over 100 years or something like that. So right now we're at a PE of like 20 or something. So PE of the S&P would tend to gravitate towards the average over time. What Walter Deemer was saying is, most cataclysmic events in the stock market are retraced eventually. So this is like a October of 22. There's a very good chance what Walter Deemer is saying that we're going to retrace that at some point in time. So retracing means just going back down and hitting that mark and then bouncing. So if we had a default, if we had some kind of major event, like the two things on my mind right now are China invading Taiwan, or maybe a default of the U.S. debt, that could make the stock market go down a lot. But these rules, Walter Deemer follows, so let's read them over just for fun. Markets tend to return to the mean over time. Excess in one direction will lead to an opposite excess in the other direction. So we found that last year. Let me see, right after the COVID rally, where everything was going up, and all the EV stocks were going up without earnings, and all the ARC stocks were going up, and they basically went down the same, basically the same amount. So that rule worked in the past year. Let's look at the next one. There are no new eras. Excesses are never permanent. Exponential, rapidly rising or falling markets usually go further than you think, but they do not correct by going sideways.
That's an interesting one.
These are all written in 1957. And I guess if we had time, we'd go over all these. The index was overbought in 2000. So this rule worked in the crisis of 2007. Public buys the most at the top and least at the bottom. That's why every week we're training ourselves with our emotion chart, to whenever it goes, and we're training ourselves with these stochastics to sell or don't buy when you're at the top of, of the excitement of the stochastics and the channel, and then whenever it gets down to the bottom, that's the time you either buy or don't sell. Okay, let's go look at the next one. He said, fear and greed are stronger than long-term resolve. Okay, so if you buy a stock, we're following individual stocks here, and we have a good thesis for each of the stocks we're following, but whenever the market's crashing, fear will overtake your long-term resolve to hold that for 20 years. And that definitely is something that happens. So you have to do the opposite. When the public buys at the top and then sells at the bottom, you have to do the opposite and buy at the top, buy at the bottom and sell at the top. Let's look at the next one. Markets are strongest when they are broad and weakest. There it is. This is one Walter Beamer picked out for today. So they're strongest when they are broad and weakest when they are narrow at a handful of blue chip names. That's exactly what happened this year. If you take out the top 10 stocks, the S&P is down this year or flat, and versus it's up 10% this year. So right now, Walter Beamer basically is saying we have a weak market, and there's a very good chance that we're just going to either go sideways or down in the near term. Like we'll probably hit down here, definitely here, but we could be going in this sideways pattern until the earnings catch up. Let's look at the next one. Bear markets have 3 stages: sharp down, reflexive rebound, and a drawn-out fundamental downtrend. Okay, so that's the problem. When we're looking at the S&P chart, we don't know where we are in that. If you go back to 2008, right here you could have said, oh, that's the bottom, but this protracted downturn lasted a whole way till March of 2008. Oh, that was the COVID low, but anyway, that's what he means by that. Let's look at the next one. When all the experts and forecasts agree, something else is going to happen. So that's one of the things that I say a lot is the stock market does the opposite of what you're going to think. So if we're all, if the primary motion in the market is fear, then there's a very good chance there's going to be a rally. And if everyone is greedy, there's a very good chance people are going to be selling off. The stock market's going to sell off. Because right now we're in greed mode, and when we look at our fear and greed indicator, and this right there, and it's just whenever we're greedy, then that's whenever we start falling in the stock market. And same thing with the VIX. If we look at the VIX is basically really low right now. That's a contrary indicator. That means no one is afraid. And that's the time whenever stock markets go down usually. And whenever the stock market is at a VIX of 30, it's whenever that's the time you just look into buying. So right now people are very complacent. They are they're thinking it's going to go up, and they're greedy. And it looks like we have like a sentiment shift right now, and there's a very good chance we're let's go through each of the stochastics just for fun for each of the stocks and sectors we're following. You can see that I'm making two charts, two lines, channels, sideways, which is most likely what's going to happen for each of these. And then we have our bullish uptrend. And we're basically, in a lot of these charts, we're getting to a point where we're at the top of the channel and we're going to be overbought, and there's, that's just an indication we're going to be going down. But the reason why we're doing these exercises, you gotta be ready with your emotions to experience that downturn whenever it happens. And so let's look at all the charts. Almost every one of them has a little uptrend going, but it's confined within this long-term sideways pattern. You can see the gold is going up. The defense sector is sideways. The XLY, consumer discretionary, that is in a sideways pattern. The other thing is we could be going into a recession. If that happens, then we'll probably be going down 10 or 20% in the stock market, but we don't know that. Let's look at the XLB sideways pattern. Same. Almost every one of these has that same pattern. So at the most, we'll go up 3% before we hit this channel. And then if we hit that channel, we could be bouncing sideways for the rest of the year. Healthcare, same thing. This did really good last year, but this year it pays a dividend, and it's probably in the trading range. Okay, same with this. Almost every one of these is the same. This is different. XLF is just sideways for the rest of the year. That's the financials. And utilities has it's a very similar chart. This is the only sector, the real estate sector, that is in a downtrend. If you see this, what we have a long-term sideways pattern, but you can see it's starting to trend down. Maybe that's because of the commercial real estate problems. There's companies are using half of the office space they used to use before the pandemic. So perhaps that is part of why there's problems with this sector. I'll go over that a little bit later on. Energy sector. It was an uptrend all last year, but this year it's just sideways. The interesting thing about oil and energy is right around now, there's a demand pickup for oil every year. For instance, everyone wants to go out and go on vacation, so they use more gas. So there's a natural tendency for oil to go up around this time of the year due to demand. So this XLE, it's highly correlated to the price of oil. Right now, oil is down. Let's look at the Brazil ETF. Okay, this is in a trading range. I just read something where someone is actually writing covered calls on EWZ. So they get a 15% yield. And if you buy, it's a low part of this channel, and you sell calls, with this being where it won't break through, that could be a good way to generate 20%. So that's, I just noticed that. But this is Brazil ETF, but they have very low PE stocks in this, very undervalued stocks in the Brazil market. Let's look at uranium. No, it's not doing anything yet. So let's look at some of the stocks we're following. AbbVie. AbbVie has a pretty major problem. Their major drug, Humira, it makes up 30% of their sales, and it won't be until 2 years from now where they recover from patent expiration for that drug. So it looks like it could be 2 years of sideways movement or down for AbbVie, because it'll take 2 years for them to resume their growth. So I have a big position in AbbVie. I'm thinking about starting to trim that and put it into something else. But this pays a pretty big dividend. but it does have patent problems right now. Let's look at, did I say Abbott? Yeah, Abby. And Abbott is a sideways pattern. You can see a lot of these stocks are starting, because earnings aren't basically increasing year over year. We're just going to have a sideways. So don't get over your skis in trying to think that these stocks are going to go up a lot. All right, Alphabet, very similar pattern. We have the sideways, and it's starting to break out into this upward channel like the indexes. But you can see we're at the top of that range right now, and we could be going like this with Google. But Google actually did break out this week. It went up 10% this week because of they introduced some new products for the AI conference. They had an I/O conference, and they basically laid out all of their AI products, which is very impressive. I'll go over that a little bit later. Altria. This is a stock that pays 8% dividend, and it's in basically an uptrend. I guess you have steady demand for cigarettes in good times and bad. Maybe even you have more people smoking when there's a recession, so to make them feel good. So right now it's very reliable, pattern of highs and lows. Amazon, it's starting to have an uptrend, but I think it's still stuck in this. It's not growing its earnings. Its main driver for earnings is AWS, and that's not growing as fast as before. So it's probably going to be stuck in this sideways until they get something better earnings. So Apple is basically at a 52-week high right now, but you can see how dangerous this is. This is an established high and low. This is a large amount of space between high and low, and there's a very good chance in a market pullback, Apple is going to retest these down to here. I'm not sure exactly where that is, 125. So I'm ready for that. I'm holding it because I know it's, every 6 years they come out with something great and resume the growth trend. And they have a reliable user base that consistently pays them money. So let's look at AT&T. It is sideways. Right now, the biggest problem with AT&T is their debt. They have a lot of debt. They have to do maintenance on their infrastructure. They have to buy new bandwidth for the cell bandwidth, and it's just a very, very capital-intensive company, and it's really hard to make a profit, especially when T-Mobile's taking their customers. All right, but they're oversold right now. But this is a pretty dangerous company to be invested in. Bristol Myers, this is basically not going anywhere. It's in a downtrend temporarily, but you can see it's at the bottom end of its trading range. Okay, so let's go just whiz through these because we have other things to talk about. You can see that almost every one of these stocks is falling into a pattern of sideways movement. So Meta is probably the only stock that's in an uptrend, a major uptrend recently, but if it breaks this right here, it's going to go back and fall into this pattern for the rest of the year. Okay, well, I think every other stock is very, very similar to this. You can go through them later. But let's go through some of our meeting notes. Okay, so right now we're in May 12th. So we don't have earnings. We have one more earnings report. That's NVIDIA, and that's the end of the earnings season. And it won't be until 3 more months that we have earnings come out. So we have April, May, June. Okay, so it'll be right here in July. That's why I have green there, because people get excited whenever you have earnings come out. But until then, it looks like we're just going to be in a consolidation sideways. Right now, we're like over at the top of our channel, so I guess that we're going to be going down for the next month or so. And what else do we have to look forward to? We have every blue is the Fed meeting date, so if we say we're done, if the Fed says we're done raising rates, and then we get some good inflation data, then that'll help the stock market. But right now, any comments?
The red color meaning it stock market going down.
Oh, I put red because I'm just looking. We're looking at Walter Deemer when he says the market's weak. Whenever you don't have participation of the whole market, just a couple stocks, right? And on top of that, you have. Let's look at the S&P. We have the S&P basically nearing the top of a sideways trading range, right? And by the time it gets up here, it's going to be overbought. I don't know. It just seems like we're maxing out right now, and we have so many fears in the market. You know, with the debt of the United States, you have geopolitical issues, and we don't have earnings anymore. So there's no real catalysts for the stock market. And a lot of times that's the time when you consolidate and when there's no news. That's kind of what I was thinking there. I mean, this right here isn't meant to like buy and sell whenever it's red. It's just you gotta have your emotions ready for, you know, the stock's going down for a while. Let me see what else. Okay, so I basically, the first couple months of the year, you know, we've had positive GDP, so we're not technically in a recession right now, and we have good labor numbers coming out. So there's a very good chance that we could avoid a recession, or it could be like the end of this year. I don't know that, but for me, I know that we just have to know to know and temper our emotions so that we know that it's going to go sideways, and you just can't get all scared whenever, you know, the stock market corrects down to here, because if earnings aren't going up, the only reason the stocks are going to go up is because of either people getting over their skis and buying things to make them overvalued or to increase the multiple, or because the earnings are going up. And earnings aren't going up for most companies. So where are we at now? Okay, so that's the calendar. We have the major events, the Fed meeting dates, we have holidays. We have a holiday coming up at the end of May. That's why I have green around there, because people get excited around the holiday. And so we can at least look forward to that. And we also have the end of June, we have end of quarter window dressing. And that's when there's an artificial amount of buying of stocks that have done good in that quarter, so that the money managers have a good report to give to their people that get the reports. All right, so let's look at our notes. We still have a regional banking crisis going on. We have some of the regional banks basically going down 20% a day, and that isn't going away anytime soon, it seems. So what I did was I gave a report later on today. Let's see. Okay, I'll go over this right now. One major problem, this could be like a black swan problem. American offices are half empty. We know with our company, we use half the office space that we did before the pandemic. So that's happening around the country. And there are companies that take out mortgages, you know, for these office places, and they're coming due, and it's going to be a problem where the banks are going to be stuck with the unpaid mortgages of all these of these office complexes. So right now, what I did was I put together this little chart of all the major banks that have large office exposure and large American office commercial commercial real estate. PacWest, KeyCorp, Zions Bank, all these bank stocks are the ones that are going down 20%. And even Warren Buffett sold his major banks that had exposure to this problem. And so this commercial real estate is going to be an issue eventually. Simon even said, commercial real estate office loans are an issue. Commercial real estate losses may take a few banks down. So, he's on top. Jamie Dimon from JP Morgan's on top of that. But all these banks, they could be taking over some of these office complexes and taking losses when they try to get rid of them. So I'm just saying you have to stay away from anything exposed to that industry. Because it could be, they say, the next shoe to drop. So hybrid work is causing offices not to be used, and we just got to keep that in mind. All right, so we have to worry about this U.S. debt default, which probably won't happen, but it just, whenever there's brinkmanship is whenever you have two sides that are threatening to do something and of a catastrophic nature, and if it ever happens, then they lose confidence in the U.S. dollar. So that whole process that happens every once in a while in America, it just makes the stock market upset, and the stock market could go down because of that. Okay, so we have most of the earnings already reported, so there's nothing, we can't use that for catalyst going up anymore. Let's see, the 10-year and the 2-year aren't going anywhere. They're basically unchanged for the past week. So the longer we go without an agreement on the U.S. debt, the more the markets are going to be on the edge. And if there is a default, I think the markets will crash, and we'll probably go back down to the October lows of last year. So if we look at our chart here, there's a very good chance if we have a default in the U.S. debt, we'll go down to at least here, then we'll go down to here, and then we'll go down to the COVID lows again or something like that. Because it's just that bad of a thing. Jamie Dimon's trying to tell everyone this is you don't play around with this, and you have to be ready for that. What else we have here? Okay, so the only stocks that are really that have momentum are the big tech stocks, like NASDAQ 100, primarily the big five FANG stocks. So we don't have that whole momentum, so that we can't use that for the stock market going up. But the U.S. dollar is pretty much flat the past couple weeks. That's not helping. And that's all the talking points we have for there. Is there any questions on that? Okay, no questions.
Yeah, question about Brazilian market. What do you think? Do you think it's underpriced?
You know what? Their stocks and let's do a quick check. I should have done that for this week, but I didn't. EW Holding. I did a quick review of an article. Let's look at what their holdings are. Well, there it is, right there. I understand their PEs, almost all of them are like around 10 or less. So that's compared to America, that's like a third less. So let's look at their holdings. Vail. Okay, so what I did was I opened up. We don't have the same information. Oh man. Well, there was an article on this and I read it. It said they're very reasonable, like half the valuation of America's stocks. So not only do you have like a 15% dividend, but you have, a diversification, that total different than the America market. So I think I'm definitely looking into that. I guess they have a lot of resource names. Let's look at the stocks in their portfolio. They have Vale. I think Vale, it's like an oil company. I'm not sure. Union Bank Holding, that's like a bank. This Petrobras is a oil company.
So they have 3 oil companies.
Yeah, I guess
so if the oil go down, they need to tank.
Yeah, that's right. That's right. Brazil, we see a bank. We have Ambev, they're a beverage company, Rent-A-Car, and an investment company, perhaps. Okay, so let's look at what their price to earnings ratio. 0.2? No. Price to book. Okay, so if you compare this to America's stocks, they're definitely all. Let's do that. Let's do that just for fun. We're going to compare this to an American stock. See, symbol. Okay, so we're gonna compare this to SPY just to see these numbers, because we can compare these. Okay, let's do a EWZ on left and SPY is on right. Okay, price to earnings, that isn't right. Price to book, 0.26, 0.71. Price to sales. Okay, neither of these are right. Okay, I'll have to research this because these numbers for the S&P are not right. Okay. All right, so I'm not an expert in the EWZ. I'll do that research for next time because it's an interesting way to diversify your portfolio, and if it's reliable, that's pretty decent to have a dividend like that. Okay. Now, let's look at some more talking points. Okay, so we're getting, the other reason, Joe, you were saying, wow, why do you have it all red for, in the next couple of weeks? We're coming into the worst part of the year, for, a lot of people say sell in May and go away. So basically people would sell before the worst 4 months of the year. It's a very good possibility that these months are going to be bad because of that, the seasonality. All right, so we're basically at a halfway point, 60 on the stochastics. So we're not either overbought or oversold, but we're nearing the top of the channel, so that's pretty dangerous. I would think that we're going to be going toward the bottom part of the channel next with all these fears in the market. Okay, gold, it's still in an uptrend as long as the U.S. dollar is going down continuously and there's fear in the market. There's going to be, especially with the debt problems in the United States, people are going to be gravitating towards gold. So unchanged, oil is unchanged since last week. Our big understanding for oil is as the economy slows, the demand for oil goes down and the price of oil goes down. And as the economy gets heated up, the price of oil goes up. Let's see, inflation. We had two inflation reports this week, and they basically are saying that we're still at around 4.98. They were better than expected, but still we're still stubbornly high inflation. So let me see. Gold is up a little bit this week. Maybe because of the U.S. debt crisis, people are noticing only 5 stocks are carrying the stock market, and that's kind of weak. So people might be trending towards gold because it's a safe investment over time, and it holds its value. Let me see. I'm going to review Dan Mouse. At the beginning of the year, he gave these estimates. There's a 50% chance that we're going to be staying in here, and a 45% chance we're going to be lower than 3,600 in the S&P. Right now we're at 4120 in the S&P. So that's about right here where the X is. And So Dan Mouse thinks there's a good chance there's a 95% chance we're going to be going sideways this year, basically, is what he said. So that's another reason why I'm expecting sideways. And Matthew, I think that's another good reason why your prediction of sideways is going to be right. So, fear, greed. We're starting to get greedy, and people are fear of missing out. We had Google go up 10%. People are excited about that, but we just have it. Google hasn't grown really this year. It's the same earnings as last year, and they're just a little bit of froth, and people are greedy. That's the time when we should be not buying and or selling. All right, the VIX is at a low, so you can see there's an inverse correlation to the S&P and the stock market. When the VIX is down, that's the time when the stock market goes down, and when the VIX is really high, that's when the stock market is down. So right now, people aren't afraid. They're greedy, and that's just when the stock market goes down. So in our valuation chart, emotional chart, where we have the enthusiasm on TV, tech stocks are rallying, and we've broken out. We're going above moving averages, and then we have the greed. That's where we are. We don't have delusion yet, but right now that's a good time that we're going to have fear and capitulation in the next month or so. All right, so we already talked about this. American offices are half empty, so just avoid these bank shares that have that exposure, because they could all go out of business maybe if they had to start refinancing and they had to realize these losses. All right, so I thought we never did this before. This is really important. I'm surprised I haven't done it yet. But how to put together a portfolio of stocks and have it diversified. And that's not an easy thing to do, because what I've been trying to do is every time a sector goes out of favor, I try to say, well, this, in a good portfolio, you have a little bit of every sector, and this is basically a sector performance chart. So last year you had certain sectors like health that went down 2%. You had the S&P 500 down 18%, but you had utilities up 1%. So if you have a good diversified portfolio, you would grow 5%. In general, whenever the stock market is down, the S&P is down 18%. But if you're diversified enough, you have some sectors going up when other sectors go down. And there are different approaches to that. And right now, I'm just trying to get a 60-40 portfolio using dividend-paying stocks and growth stocks. That's kind of what I'm doing with my portfolio. But every time a sector does go down, like right now, finance, banking, that's like the sector that's pretty out of favor. And right now, I don't have that much in my portfolio. But you have to look at last year. We went down 30% in a lot of tech stocks. That could be time to start getting into some of the tech-oriented parts of your portfolio if you're interested in that. Okay, so what's in the S&P 500? Let's say it's one of the most diversified indexes. IT is 28%, healthcare 13%, and we go back down to energy is only 3%. So this is like an example of a diversified portfolio of stocks, and right now it's market weighted. So it has these weightings because the information technology are the highest growth companies, and because the S&P is market weighted, the most successful companies, they grow to the biggest market cap, and they become bigger portions of the portfolio of the S&P. So this is an example of a simple example of diversifying. what I thought would be interesting, Jim Cramer runs a program, a skit called Am I Diversified on his show, Mad Money. And what I'm going to do is I'm going to go through some portfolios that were actually on his show. And we're going to look at it and we're going to decide whether they're diversified or not. And he also throws out bad stocks. His theme is if it's a unreliable stock, a stock that's maybe a small cap, that it doesn't have a whole lot of reliability, let's throw that out and put something in more reliable. And if you don't have enough of, let's say, this diversification, he would recommend getting rid of one stock and maybe put a drug stock there instead. But here's a Edward Jones recommendation of sector weightings. So this gives you an idea of what Edward Jones thinks you should have in your portfolio for diversification. And so what I did was I did that same thing with my portfolio too, just so you can see how I kind of try to be diversified anyways. I'm so undiversified, but I'm trying over time to be more balanced. Okay, so we're going to go over a couple of these. Am I diversified? Okay, James in South Dakota. I didn't spell it right. Mark, Devon Energy, Stag, BAC, and CAT. So Mark is a drug stock. You have Devon Energy, they're oil stock. STAG, Stag, they're a real estate trust. Bank of America, they're a bank. And Caterpillar, they're an industrial. So, well, but one thing that's missing from here is maybe a tech stock, because that would make it balanced, because you don't have any growth in here at all. It's mostly dividends. But let's look at what Jim Cramer said for this. He said it's perfect diversification. You have Devon, that's a high 9% yielding stock. You have Bank of America, they have a good yield. Merck has a yield of like 3%, and they're growing. And Stag is a real estate investment trust, the 4% yield. So this is more of a yielding portfolio. Okay, that's the theme of this one. We're going to go over the next one, and you're going to have to decide if it's good or not. So this one is from Pyros in California. The stocks are Costco, Disney, Pfizer. See, Costco is a retail, and Disney is an entertainment company. Pfizer, a drug company. JP Morgan is a bank, and GE, and they do aerospace and diversified manufacturer. They just broke up their company, so now what's left is mostly aerospace and some more manufacturing. What do you think about this portfolio? Anyone have any ideas if it's missing anything, or is it diversified?
What was your question, Greg?
I was wondering if it's your Jim Cramer now. You're trying to say this guy called in, and you have to determine if this is a diversified portfolio. If not, what would you recommend to change it to be more diversified?
This is kind of the like a little bit of, these are all big companies, right?
Right.
This is all going to be kind of, it's like a Dow Jones industrial type portfolio, right? Where you have 15 big stocks or something, right?
Right. He said the top 5 stocks in your portfolio. Give me your top 5 stocks. I'll tell you if you're diversified or not.
Yeah.
And a lot of times they give them big caps, but I've noticed that Jim Cramer, he shies away from smaller stocks and stocks that aren't reliable and replaces them with more reliable big cap stocks.
I feel like if the economy go down, majority would be, three or 5 would just go down in sync together when the market go down.
Oh, okay, that's a good comment. So right now, let's go through that comment for each of these. Costco makes most of their money through through fees. They charge $9 a year for their membership, right? And there's like a 99% renewal rate. And even in bad times, there's a recession, people renew because they want the cheap oatmeal that they get 20-pound bags of, right? So I think Costco doesn't go down with that with the economy as much because they're not really counting on selling chickens to make their money. They have the renewal fees, and they have a renewal. They're going to be increasing the prices on that pretty soon for the membership fees. So, but let's look at Disney. Disney is definitely going to be affected by a downturn in the economy. You're right. That is, did they call it cyclical? I think it is. Cyclical is whenever the economy goes up, it does good, and when the economy goes down, it does bad. Pfizer, people are going to be buying drugs, whether it's a good economy or a bad economy. With drug stocks, it's pretty neutral to economy going down. But I guess Pfizer, they're not having the COVID sales that they did 2 years ago. So, but I don't think it's as affected by the economy. J.P. Morgan, definitely. They have more defaults whenever there's bad times, and they might have more problems, and it's affected by that. GE, people aren't flying as much if there's a recession, so they're definitely affected because there's less factory orders and stuff. So you're right, half of it is going to be affected by the economy, half it isn't. So I guess in that sense, it's kind of diversified, you know? Let's look at what Jim Cramer
Actually, 3 out of 5, so that will be more than half.
Yeah. Yeah, right, you're right. Okay, so let's look at, Cramer thinks it's perfect. He said there is more high growth and less dividend in his portfolio, but he blesses it. Okay, so that's great. He likes it. The next one, Josh in North Carolina says, Wells Fargo, Marathon Digital Holdings, a very small crypto company, Boeing, NVIDIA, and Caterpillar. What do you think about that portfolio, and what kind of advice do you think Jim Cramer would give for that?
I like this one more, but I don't like crypto.
Oh, okay. Okay, so we're taking out Marathon Digital.
Yeah.
What do we want to put in its place to make it more diversified?
Retail, like Walmart.
Okay, that's a good one. I like that because we're going into a recession and people are going to be trading down. And then actually Walmart's in an uptrend right now. So that's a really good choice for that. Any other ideas that makes this more balanced? Okay, let's see what Jim Cramer said. He said, Marathon, no, because it's a crypto company. That's right. You're right. It's a small company, too, and they're heavily relied on something that's unreliable. He said, add a drug company, Merck, to be diversified. Okay, so we didn't have any health care in that, and not a whole lot of dividends. So that's a good example. I want to go to the next one. Next one is Sunny in Illinois. Pfizer, Paramount. Pfizer is a drug company. Paramount, they do streaming, very similar to Netflix, but much smaller scale. Redfin, they do real estate. AT&T is a telecom, and HPE, they do computer systems and services for computers. What do you think about that portfolio?
As a Redfin investor, I take out Redfin.
Oh, really? Okay, all right.
So I made money on Redfin. I kept 15 shares, and it went down, 95% or whatever.
Oh, man.
It went up 15% this week.
Wow. Yeah, so this is an example.
Take out AT&T too.
Okay, we're taking both of those out. And why do you take AT&T out?
It's been down for as long as I remember.
Right. Well, okay, let's see what, oh, okay. Let's look at, so the other thing is...
Hewlett Packard doing? I don't even know.
I don't know. Hewlett Packard was one company. They spun off into a couple companies to add value a couple years back. I've lost track of what they do. They're actually a competitor to Dell in a way. So
yeah,
what?
I think they're the not good competitor to Dell. Yeah, that's what I said. Who
Yeah.
with Dell? They're not as good as Dell.
Yeah. So let's look at what Jim Cramer said. Pfizer, he likes it. The dividend is great for Pfizer. Paramount, it's too small, it's too levered. He's worried about the dividend. So Paramount, they're a competitor to Netflix, and they're trying to build their market share, but they took on some debt to do that. So it's a smaller company. One of the things he tries to go to larger companies with a moat that have, as a good way to diversify. And let's look at some of the other things. Redfin, he says, barely a stock anymore. I'm not going to touch it. Real estate, he said, go into Federal Realty Trust. It's a REIT, and it pays like a 5% dividend. I think they hold REIT real estate of government agencies, so you have a little more reliable payments. AT&T, he said it's too levered. That means they borrow too much money. He doesn't like the balance sheet. He said the AT&T and Verizon dividend are not safe. We kind of been saying that for a while. That T-Mobile, he said, I would switch into T-Mobile or Raytheon. He ended up choosing Raytheon because T-Mobile didn't pay a dividend. So HPE, he says it's a challenge company that buy Dell instead. So I thought that was an interesting. We have one more. I think this is worth it. Terry in Washington had these stocks as his top 5. PXD, Pioneer Natural Resources, they have a 10% dividend. Caterpillar, industrial, they sell tractors. Eli Lilly, a drug company. Wells Fargo Bank, and Palo Alto and their cybersecurity. What do you think about that portfolio?
I'd switch to the bank. I don't like Wells Fargo.
Okay, Wells Fargo. Any other ones? Any other changes? Okay, so one problem about Wells Fargo, they might be slightly involved in that corporate real estate mess, where they might have written some mortgages on office space, so that could make that be a bad pick for this situation right now. I'm not sure. Let's look what Kramer says. He said, this guy is terrific, no changes. He actually, this Wells Fargo is in his charitable trust. He always says that, so he likes Wells Fargo. But he says we have Pioneers, great oil company, a 10% dividend, and Caterpillar's industrial. Had a monster week, this Eli Lilly, because he had some good news on a lot of different ways. And Palo Alto is a cybersecurity, and he said they were crushing it. So he liked that. The last thing I wanted to show you is how I kind of looked at my portfolio and how I try to diversify over time. Right now, I just updated these. With Apple going up and Google going down, my percentages is like Apple 24%, Google 20%. And what I did was I added at the bottom here, the percentage in each of these different sectors. So for tech makes up 56% of my portfolio now. I mean, that's not diversified. But I have 10% in fintech, which is MasterCard and Visa. And the reason why I have such a high percentage is I have a pretty high confidence that they're going to continue their monopoly and not get pushed out of that space anytime soon. And so I'm going to, for the drug, I started getting into drugs. They pay a dividend. And also what I did was I put in dividend and growth. And I looked at my portfolio because there's something called a 60-40 percent. So 60% stocks, 40% fixed income. And I don't know anything about fixed income. And we haven't had that opportunity until this year. So I've been trying to do that using dividends. And so I have like a 70 stocks, 30 dividends portfolio. So 70-30. So I'm getting 30% of my stocks yield something. And my average yield in my portfolio is like 1.5% right now. So over time, what I'm doing to diversify more is I'm trying to, as I have the opportunity to move from the tech into more some of these other sectors to be more diversified. So I'm lopsided right now, but I'm getting there. But in general, I think my 70-30 is pretty decent for my position in my career and everything in my plans. So
I have a question for you.
What's that?
I have a question for you. Did you submit this portfolio that we currently have to that guy?
Oh no!
What do you think he would respond?
He would say my top 5: Apple, Google, Microsoft, MasterCard, AbbVie. He would say you're too tech heavy. Why don't you get Raytheon in there? Sometimes I think what he would say.
The question I follow up with is, and I have similar problem. If to diversify, we have more than say 10 of magic number of stock. I mean, we all look like we have one too many.
Yeah.
I mean, when will be enough diversify, and when will be too much diversification?
One thing that Charlie Munger said at the Berkshire Hathaway meeting this past Saturday, 2 Saturdays ago, he said he calls it diversification. He says, I want my money in the best stocks that I can get. I want my first and second choice to be top holdings. I don't want to be diversification into other things that aren't as good as companies. And Warren Buffett says diversification is a good excuse for incompetency.
So Greg, I guess my question for you is, what is your purpose for like all these small holdings? Are you like buying to just view them, like to keep an eye on them? Like what's the point of having 0.5% in something?
That's a good question. A lot of my stocks, my approach to buying stocks, even with Apple and Google, in 2007, I bought like 0.5% of Google as my first position, and I hope it goes down. I hope, and it went down. Both Apple and Google went down after my first purchase, and I bought more. But sometimes it doesn't go down, and I have a habit of just making a bunch of starter positions, hoping they go down, and then they end up going up. So I'm stuck with a starting position, and I don't want to chase it. Does that make sense?
I'm sorry. Are you hoping to go down?
Well, say if you're dollar costing, this is my approach. It might not be right, but what I do is let's look at a chart at the S&P, for instance. Let's say you're investing starting right here, and you put all your money in. There are two approaches to investing. You can put all your money in at once, or you can put your money in a little bit over time. And there are studies that say, well, it's better just to put it in all at once, because over time, my approach is to buy whenever you're interested in something, like let's say the EWZ. We've been following that for a couple of weeks now. If I put a 0.5% position in it, that's 0.5%. And it seems like a good situation. You've got some stocks that have a low PE ratio, much lower than the multiple that you pay for America. My attitude is I want it to go down so I can buy more of it at a lower price. And so that's been my approach. And that's what Warren Buffett says too. He says, I buy a stock, I want it to go down because you can buy more at a lower price of a good stock that you've already done your research on. But a lot of times I buy my first position, and then either one or two things happens. One is the stock goes up, and I I missed that opportunity. I could have bought more, but I didn't. So I'm stuck with this small position. Or, news comes out that maybe it didn't do as good as my initial thesis. So if you do your homework and you say, well, that wasn't that thesis that they said in their report didn't actually come to fruition. So maybe I'm not going to add to it, and I'm going to watch it. So it's like half and half for me for those that I'm stuck with in this lower end, this 1% range. Like I bought Verizon, for instance, right in the pandemic. I said, wow, this is an opportunity. It's crashing. But because I wanted to get a little more diversified, I didn't have a whole lot of dividends in my portfolio. But I made a starter position, but it ended up it hasn't gone anywhere in 2 years, 3 years. And it's losing market share now too. So that's an example of a stock I had a thesis that I wanted to buy and hold this and divide 72 by the yield, which is 8%, and you get, how many years it takes to double that stock. That was my theory on Verizon, for instance. But it went down, so I'm kind of stuck with the 1% position. Does that answer your question for that?
Yeah, I think so. My approach is to have kind of fewer positions and to get diversification from broad market kind of ETFs.
That's probably better. Sometimes I wish I didn't have so many positions because I got to follow all this.
Yeah, and then you can put more time in and have more conviction. That you only buy the ones you have more conviction on, rather than having so many positions that you can't keep track of it all. You can't keep up with what they're actually doing.
Yeah, that's right. That's right.
And there isn't much upside to having like a half a percent of your portfolio in something, right? Like even if it doubles, well, that's great, but then it's like, well, was that one of my best ideas, or did I get lucky? What if you have fewer positions, you have more conviction in, then you're.
But Greg, half of a percent of a couple of millions is still a big number.
I don't know about that. But yeah, it's all about percentages. When you look at if you buy a stock, you have to think just percentages. How much is this? I'm investing a percentage of your portfolio. That's why you have to break it down into that. And if you set rules, my initial starting position is 1% or 0.5% or something like that, then that allows you to at least knock it over your skis and put all your money in at once and sell out when it goes down.
Yeah. I guess I'd want to either keep dollar cost averaging into it or have a time limit for when I'm going to get out of it. I've sold out of winning positions when I lost. My thesis is no longer true.
Oh, right.
And so so if it's even if it was if it's winning, then you keep dollar cost averaging into it, or if something changes, you start getting out.
Right.
So that's a little bit what happened with Redfin. I liked Redfin for a while, and it went up higher than I expected it to go, and I saw the movement of the company, the plans they were making didn't seem like they were good, and so I sold most of my position on the way up, and then I had a small position left, and it crashed down to nothing. So that reflected that, but it was fine. I was fine with that. It reflected my thesis of when it was going up, I'm I think it got overvalued, and then they started making moves. They started getting into buying homes, and that's not why I got into the stock. That wasn't my purpose in the stock. My purpose was that I thought they were a better service than their Zillow. I really liked a lot of things about their website and their service versus Zillow, and so I thought they were a good competitor there. I was interested in their that they were doing transactions, and I thought there was some disruption to be made to the 3% on each end buyer seller fees to the brokers. Mm-hmm. And so they were doing real estate. They were hiring real estate agents and taking a smaller percentage. I still think that market has some some availability for disruption. I think that there is not symmetrical work for the buyer and seller agents, and I think that the current kind of default 3% rate on each side is ridiculous.
Yeah, I agree with that.
And and partly because the market's changed. The way the like MLS works and the internet, it's very different than when you had binders and were copying sheets and having to send them around, right? So like I think that's the payment structure is still situated in a pre-internet method, right?
Right.
And so I think that's not going to last forever. But Redfin, kind of as they got away from my premise, I trimmed my position and mostly got out of it, and then watched my last few shares crash, and I should have just gotten all of it out.
Yeah, there's actually a lawsuit against the Real Estate Agents of America or something like that, because they have this 3% sell, buy, sell lock on the market, and there's no room for changing that business model, right? But come to think of it, when we're talking about Verizon, it's a small portion of my portfolio, but my thesis, this is an example of when I should really sell, because we see T-Mobile eating market share of Verizon, and Verizon's going down, in stock price, and we have Jim Cramer saying that they have too much debt, and they're so they're losing their bit. So this is an example of a stock that I should start trimming or exit. As an example.
Your thesis, the company's position has changed your thesis. Yeah, and so I think that you should, have a set date then, and then review it, and then leave the position.
Right.
If you don't have faith in it anymore, and then it takes it off your spreadsheet. It lets you focus on the ones that you really have confidence in.
No, I agree with that. Yeah, that was good. Yeah, that was a good exercise. I think that was we did something today. All right. Well, I think I've overextended my time. So thank you very much for attending, everybody. And I hope you have a good weekend.
Thank you, Craig. Have a good weekend.
All right. See you next time.
Bye.